turn our attention to the oil and gas space now. Mahanagar Gas has reduced the CNG and PNG prices as the government has lowered the HPHT gas costs. Probal Sen, energy analyst at ICICI Securities, joins us on the show. Hi, Probal. Good morning. Well, tell us what caused that big rally in MGL yesterday. The price cuts will lead to more volumes. Is that what you're factoring in? But I also wanted to ask you, because HPHT is not such a big part of their sourcing. So how does it fit in then?
Actually, there are two aspects to this. One, as you rightly mentioned, the price cuts will obviously increase the competitiveness of CNG and PNG prices against petrol and diesel. If you remember, last year at one point of time, because of the fact that, they had to pass on a lot of the spot LNG price increases, the differential between petrol and diesel and CNG had actually dropped to a multi-year low of less than 30%, close to 25%, which is not a very economical level for people to convert or opt for CNG vehicles. That differential, thanks to the price decreases that have happened once in April because of the reduction in the domestic gas price formula, and now because of the softer HPHT prices, which are expected there from the 1st of October, that differential is now growing to more than 50%. So obviously that does create a lot of incentive for people to shift or opt for CNG vehicles. That's number one. To answer your second point in terms of what HPHT is as a percentage, at the margin, if you see, domestic gas allocations have been reducing consistently to the CGD space. They were at levels of around 8 to 9% a year ago, reached about 10%. And currently our understanding is that there are somewhere between, the allocation was about 90%. And now the allocation is actually down to about 87 to 88% from what we understand. So because of that, the extent of HPHT or spot LNG, whatever you can source to meet your priority sector requirements, has gone up to about 11 to 12%. What our understanding is, as far as MGL is concerned, is that they already have around 0.2 MMSCMD of contracted HPHT gas, plus they are also able to today source HPHT gas from IGX, which is the exchange at which certain Reliance volumes are available, to the extent of the balance. So the requirement to buy spot LNG at $13, $14, which even though it's low, is still slightly higher than the current price of HPHT, is negated. So if you combine everything, it creates a situation where they can pass on some of these benefits to the customers and yet have fairly strong margins going forward for the rest of FY24. So those factors have just come together, perhaps, to drive a little bit of positivity.
Okay. Probal, hi, good morning. Two questions. One, what is your one big pick in that space? And second, if you can talk to us a little bit about refining margins and what's happening there. And is there a big play coming on the back of, refining margins globally being very strong?
Firstly, as far as the gas space is concerned, we have remained fairly positive on GAIL. We do believe that, recovery in transmission and trading volumes, the improvement in tariff that happened, earlier in this year, the steady trading margins, the improvement in LPG prices, the, visibility around the gas costs for the LPG segment, and, a recovery at the margin, even in the petchem segment, means that, earnings momentum will continue to be fairly strong for the state, for the name. That is something that we have maintained for a while now. We remain positive on IGL and MGL in the CGD space. I think both companies, because of the factors I just mentioned, perhaps they're playing out more strongly in MGL, but for IGL also, our sense is that, some of those factors remain relevant. And our sense is if crude prices remain at this strong level, then there's no downside risk to the cap of $75 realizations for ONGC and Oil India. And their gas realizations at $6.50 are still well above their last 7-8 year averages. So those five names, I think, will continue to be strong. OMCs, despite, the kind of refining strength that you talked about, at this point of time, I think the kind of losses that are still there in the marketing segment probably will keep the stocks in a narrower range. As far as, your second question, the refining strength is obviously very, positive from a downstream petroleum perspective. However, you have to also keep that in the perspective that there is a windfall tax that is being levied, which takes away a significant part of the gain that Indian refiners can actually make, specifically at least to the extent of the exports that are happening.
Sure.
And,
All right, Prabal.
Yeah.
Yes. Sorry, we actually have a market opening in a couple of minutes, so I didn't want to interrupt you at that time. So I thought I'll just end the discussion now, and perhaps we can take this, point forward. Thanks a lot for joining in and speaking to CNBC TV 18. But